This is TreppWire Week in Review for week ending January 6th, 2023. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Hendry, Head of CRE and Advisory Services. This week, after 3 days, the House Republicans are deadlocked in their vote for a speaker. And Fed minutes show the committee will stay on course in its battle to tame inflation. In economic data, manufacturing contracted in November, but a number of jobs reports highlighted a resilient labor market, even as new layoffs are announced in tech. Manus, the Wall Street Journal and other media are reporting that most economists are predicting a recession. It's just a matter of when. So there's certainly plenty of negative sentiment to go around.
There certainly is, and it's really been there since December 1st, I would say. We've gone through fits and starts since June. June was a turning point last year with the miserable CPI number. We've had a couple of bear market rallies in between then and now, but starting December 1st, we really had a negative sentiment really almost every day since then. And I would say the early data that we've seen in January 2023 has been somewhat stagflation in its indications, right? On the positive side, on the inflationary pressure side, we've seen a surprisingly high jobs opening number, a high ADP number today. For that, a pretty resilient workforce. At this point, unemployment, as we know, going back to last month, still under 4%. So that's the inflation part of the stagflation equation. But the PMI numbers this week that came out, both the services and the manufacturing, both firmly in contraction territory. So I think that the Fed still has a lot on its hands. It certainly admitted such with its minutes this week when it came out and said unanimously that none of the board members were calling for rate cuts in 2023. So they still see inflation as the big dog that they have to fight for the next 12 months. But I have to say, they can't be completely ignoring some of these job cut news we saw this week. 18,000 from Amazon, 10% from Salesforce, Goldman and Morgan Stanley this month laying off people. That's real, and eventually it will add up. So, I've been calling for a shallow recession. I still remain in that camp, but I do think that the winds of stagflation have picked up a little bit this week, and that's not a good thing.
Yeah, so just to piggyback on the Fed comments, man, as you said, none of the 19 members, think 2023 rate cuts are appropriate. 17 of 19 said they expect rates to rise above 5% this year. The Minneapolis Fed President Neil Kashkari said he thinks Fed will have to hike interest rates to 5.4% before pausing. So again, just more sentiment that shows. And I think if you attended our Market Pulse webinar, we showed the dot plot and how the sentiment has changed around the dot plot. And I think this just confirms that we're going to see sustained Fed pressure on continuing to monitor this, potentially seeing increasing rates. Fed, Bullard's comments from a few months ago maybe are not that far off of where we end up. We all thought he was crazy, but maybe we end up tracking there. On the job market side, I'm with you. We've seen a lot of headline around layoffs and cuts. And I think some of the big headlines this week were Amazon said they're going to cut 18,000 more jobs. Salesforce said they're going to reduce, I think 10% of their workforce. And they actually said they may exit some select real estate markets and have office reductions. Those definitely are not great bullet points. But if you look at the job market numbers, unemployment benefits in the last week of 22 fell to a 3.5-month low. Private payrolls in December rose to 235,000 for the month. And it looks like, there's a sentiment around people retaining, top talent at their workforce. So I think it's kind of a mixed bag, depending on what you look at. The manufacturing index, the figure 48.4%, which was, 0.6% lower than November, indicates a contraction after 30 straight months of expansion. So kind of a mixed bag from my perspective here.
The question I would ask, Manus, is looking at some of the downsizing at these tech firms, does that end up getting an impact into other sectors? Do we start to see other companies shrink their workforces, or is this simply an issue where these technology companies were hiring over the last few years and now they realize they don't need those people?
I think that's a great question. And I think you could you could answer it one of two ways. I think you could be right with both answers, right? Salesforce came out today and said they just hired too many people going into COVID. They just overspent. Going back 6 months, Amazon said the same thing with its warehouses. So I do think that whether it's Zoom or Salesforce or Amazon, there was this expectation that COVID would change everything forever. And that wasn't the case. And I think that they're paying a price for that now. And even in retail with Target and their inventory issues, that's true. But I don't see how this can't permeate into other areas. And if you focus specifically on commercial real estate as one area, you have to think that this is a real headwind, right? That for the last 5 to 10 years, tech has dominated stock market returns. Well, it's also dominated the taking of office space in many cities, right? Whether it's Atlanta, the Washington, D.C. area, New York, San Francisco, Seattle, Salt Lake City, everywhere you look, Austin, Texas, Facebook, Amazon, Google, Microsoft, et cetera, have been taking huge swaths of space. They were the incremental buyer of Class A space. They are no longer the incremental buyer, and I'm not sure that there is an incremental buyer out there right now. It's certainly not law firms. It's not hedge funds, certainly in terms of taking additional space. So there has to be some ramification there. And then if you go one step further, places like Microsoft and Apple and so forth are makers of products, right? They buy chips, they buy casings, they buy everything that goes into making their products. And to the extent that they have a downdraft, right, that too will infect others as well. Microsoft today, their CEO came on and said they're looking at a very tough 2 years ahead. So to think that can stay isolated or siloed, I think it is a hard argument to make.
Yeah, I agree with you. If you want to find some silver lining, though, it looks like leisure and hospitality has been really resilient. So of the 213,000 service jobs that were added, 123,000 of those were in leisure and hospitality. And ADP reported, annual pay increase across all categories they track was around 7.3% last year, but 10.1% was for leisure and hospitality industry. So we know going into COVID, they had to reduce staff. They really were feeling the impacts in that leisure and hospitality sector. And it feels like maybe they've hit their stride, and that's a pretty strong silver lining. So I agree with you. I think there's a lot of storm clouds out there. At some point, this is going to hit a critical mass. But hopefully, maybe for some of these other sectors, they're able to see some sustained growth, in a limited capacity.
Two more stories that I thought would be good for us to comment on. One was, we've talked about cost cutting, and Twitter was in the news for its severe cost cutting and some perhaps unconventional methods of cost cutting.
Well, we did see them stopping rent payments in San Francisco and other places, although I'm not sure that's what you're referring to, Martha. We can get into the weeds a little bit about some of their spoken about cuts, but they stopped paying rent in San Francisco. So that 400 Market building, or the Market Square building, I should say, the $400 million loan on that property, the story just keeps getting more negative there. They have offices in Seattle and in New York that they've said that they're moving out of. I'm not sure, the stories that I read, it was unclear if they're still paying rent in those offices or not. But, their tentacles go beyond San Francisco, and these properties that were once Class A properties with really desirable tenants, or tenant in this case, in the case of Twitter, now becomes an undesirable asset to lend against, a bond that you wonder how it's going to ultimately resolve, and a tenant that is unlikely to stay there. So it just goes to show how the winds of fortune in commercial real estate can change very quickly.
Yeah, if you look at the Twitter building, we have some really detailed information on that property. You want to talk about Class A, that building had extensive renovation prior to Twitter taking it down. I think we're maybe starting to see the momentum shift. I mean, what we've noticed throughout this, 2 or 3 year stretch post-pandemic of office tenants still paying the rent, even if they're not occupying the space. It doesn't take a whole lot of these to stop paying to where this becomes, a crisis fairly quickly. And in this particular case, the loan matures, the tenant's not paying the rent, and everything you just outlined, man, it's just, went from bad to worse. But I think instead of going in the weeds, we might have needed to go in the stalls on this one, because I heard there were reports of bringing your own toilet paper to the office. And so I don't know if what was perceived as a luxurious job a few months ago maybe has taken a pretty quick decline into something where people are not that super pumped to be there.
So Lonnie goes there. We did see the article this week where it was rumored that Musk told his employees that they had to bring their own paper towel and other office accoutrements. And it just made me think of all the jobs I had in the past that I did just for the money when I was a kid. And I thought, well, the benefits aren't very good or the working conditions aren't very good, but the money's good. And I guess at what point does, you just kind of say, well, it just doesn't work anymore. I just, you could pay me an infinite amount of money. If you're not going to provide basic services, I'm not coming anymore. I think Musk may have crossed that Rubicon over the last 48 hours.
And the other story that I think we've talked about probably in one of our last podcasts was a big vote of confidence for a fund that had a wave of redemptions in December. And we saw a story this week that University of California is investing big time in the Blackstone REIT.
Yeah, we had talked about that. There have been a couple of REITs. They were one, I think Starwood was another, that had to cap their redemptions. Redemptions were coming in fast and furious. They had the right to limit quarterly redemptions at 5%. Both had triggered that clause. It rattled the markets to some degree. It ran the risk of people lining up in droves to take their money out, even in the future, kind of lining up to be in the next 5% tranche of people getting their money back. But, these firms make their money on size of the fund and the fees that they charge. And when they're growing, that's a great tailwind. When they're shrinking, that's a headwind. If they get a run on the bank, which is what you would call mass redemptions, that can really, really eat into your profits. And if you're levered or you have assets that are illiquid, hard to sell, and if forced to sell would be selling at discounted prices, it becomes a real negative story. So I think that in the case of the fund, getting California to come in there and bet was a little bit like Warren Buffett betting with Goldman Sachs after the great financial crisis. You could remember he lent $1 billion to Goldman Sachs, and it was considered a big vote of confidence for banks at that point. It helped banks stabilize, at least in the view of the public. The terms were slightly different, as Donut Shorts was pointing out to me on Twitter this week, but the goal was the same, right? To end the run on the bank, to end the lack of confidence. And that's what we had here with the fund, that getting this big infusion of cash from the University of California was a vote of confidence. Hopefully it changes the narrative. The fund's value was up considerably after the news came out. And now they can probably go back to stabilizing the size of their fund and perhaps looking to grow going forward. So I think it was good for the fund. Was it good for the University of California? I guess time will tell. I've seen multiple reports on that. I've seen a lot of cheerleaders who said, this is terrific. Their fund is backstopped, right? Their gains are guaranteed, and they're going to make an 11% return over 4 years. That's terrific. And, others were saying they're a go anywhere type of thing, like an endowment like Harvard or Yale. In this kind of environment, maybe they should have held out for more. I don't know. I think it's a mixed bag, but I think for the fund, it certainly changed the story for the better.
It definitely allowed them to take control of the narrative. I mean, President Jonathan Gray did the road show after the announcement and really kind of set the tone. So I guess we'll see how this plays out. But I think for now, at least, I definitely agree with you, Manus. It acts as a vote of confidence and allows, Blackstone to get out in front of this in a way that they feel like is more advantageous in, some of the narrative over the last couple of weeks leading up to this.
So the delinquency report is out and the rate has moved up slightly again last month, and it's now above 3% for the first time since July.
We've now seen 3 or 4 consecutive months of increases. We hit a trough, I guess it was in September, about 2.92%, if I remember correctly. Since then, we've seen 3 or 4 consecutive single-digit upticks, and now we're at 3.04%. So the climb has been very, very flat thus far. So there's nothing alarming in there yet. I think the consensus for the market is that this number will continue to rise. It's certainly our prediction that we made last month. Lonnie and I and Martha put our predictions in the last podcast. A delinquency rate of 4 or 5% over the next 12 months is not out of the question as loans mature and getting refinancing is hard. But at the moment, the increase has been modest. Modest might be even overstating how small the increments have been thus far. Going by property type, industrial basically unchanged month over month. Lodging continues to just completely defy COVID expectations. Delinquencies were once over 20%, might have even been 25%. They fell another 25 basis points, now 4.29%, as that market continues to really recover nicely. Multifamily, another crack there, that went above 2%, a rise of 36 basis points, driven mostly by a big delinquency in San Francisco of the Veritas portfolio. Office slightly improved, 6 basis points. Delinquencies there remain very modest for now, until we start seeing maturing loans come due in the rest of 2023. And retail was up, driven largely by the delinquency of the Palisades Mall, which is a big Rockland County mall in the New York suburbs.
Yeah, if you look at the sector that jumps out at me, I agree, lodging and multifamily. I'd like to hear maybe for some of our listeners what the lending appetite is on hotel assets right now. I know a couple of years ago, nobody wanted to touch hotels at all. And we've seen through our taller data consortia that's ramped back up, not to pre-pandemic levels, but what was, an untouchable asset class there for about 12 months. We started to see some uptick. So I wonder if there's a growing appetite there. To your point, Manus, the delinquency numbers are improving. And as we've seen, RevPAR, ADR revenues for hotel assets across the US have been really strong. Multifamily stuff, though, is interesting. I know it's led by a really big complex, but at the 2.17% that it is at this month, it's higher than it has been over the last 12 months. It's a new, high watermark. So it's interesting to see if we're starting to see that really slow down. If there's been a lot of articles and a lot of talk over the last couple of weeks about rent growth, not just stopping, but actually reversing. And I think we're going to start seeing, we've been focused a lot on office, but maybe there's going to be some more multifamily as these maturities for 2023 and 24 start to get a little bit closer.
One of the best things you see about, the last week of the year and the first week of the new year is all of these articles about year over year comparisons or the biggest 10 leases or sales or so forth, either for the whole year or the second half of the year. And one thing that was notable for me was the real drying up of transaction volume, whether it's at localities or nationwide in Q4. I saw several headlines this week which said, I think it was Manhattan leasing or Manhattan sales, down 40% from the same time last year. Same thing with nationwide volume of sales, right? So clearly the velocity of money, the pace at which people are buying properties, selling properties has slowed. And that is just a direct impact on higher interest rates and the impact that higher interest rates have had on values.
I think one of the components of that story that we probably don't talk enough about is the impact to the industry. I mean, like we've seen the mortgage loan broker, the origination desks, lay people off because there's been no refinance. But on the brokerage side, if you take, transactions down 40%, that means there's a lot of brokers that didn't close deals last year that probably had been closing deals leading up to that. And that loss of income, I mean, those participants get paid when deals close. If deals aren't closing, like there's definitely going to be some pain in that community. So hopefully for the betterment of them, like we can start seeing some leveling off and maybe people getting back in the market, or maybe closing that bid ask spread that we've talked about over the last couple of months to get some of these transactions cleared.
I'm with you, Lonnie. I'm always rooting for the underdog, and I don't like to see people struggling. And, seeing the layoffs among servicers and originators on the residential side is never a happy thing to see. And, if we see a shallow trough and if we see velocity pick up, there shouldn't be a lot of layoffs in the brokerage and origination space commercially, right? If this becomes a 3 or 4 month, 6 month thing, that type of thing. So we keep our fingers crossed. We know that a lot of the people in this industry are listeners, and we're rooting for you, and we hope that the market rebounds. That would be good for everybody.
Moving on to some property news. Let's start with office. We've talked several times about the idea that we've seen out there a number of times, converting office space into alternative uses, everything from multifamily to hotels to schools, all kinds of things. The latest was interesting. I saw a number of stories, one from the New York Times, where this firm Backlot, which provides location services for film and TV crews, offers landlords a way to earn revenue from their empty office cubes. This firm Backlot provides about 22 million square feet of offices, restaurants, retail space across New York City, and they handle everything from scouting to preparing the location and doing the negotiation. And they've got a nice list of what looks like commercial real estate clients.
Well, I'm not sure what the impact of that will be. I think it's an interesting business. I'm not sure if that will drive demand and end up being a net positive in any kind of size for the commercial real estate space. But it does make me think of when they get around, when Michael Lewis gets around to writing the book on the TreppWire podcast and they turn it into a movie, who's going to play Lonnie and Martha and Haley, right? I could see maybe Russell Crowe, a young Russell Crowe for Lonnie. I'm still working on Martha and Haley to see who they would play. But, you could probably see our headshots on Twitter or on our webpage. So if you have ideas for who should play us in the TreppWire podcast, the movie, the sequel, by all means, let us know, because I'd be curious to know what you think about us and who we would be.
Please be kind.
Yeah, I was saying, I think on your lead in on this one, Martha, it's like we work, but instead it's we film. And the question I have for this business is, are they really going in and filming vacant office space? Because if you go in and you film office scenes with a bunch of workers there, people are going to think it's misplaced because there's not a lot of workers in offices. So are they just going in and filming the vacant cubes so that people get a good feel for what today's office environment looks like?
Perfect for a post-apocalyptic film of, Cloverfield or something like that.
So let's move on to some of the stories we have listed. We've got a few.
All right. So we had a lot of these stories last week, but we were doing our predictions. So some of these go back a little bit, but we hadn't reported on them in the past. Starting with green, this might be the mother of all green shoots for Manhattan. I love this one. This was brought to my attention by our analyst, Jen Spillane, yesterday, and we wrote about it in TreppWire this morning. Fox, so the Rupert Murdoch news organization, renewed a huge lease at 1211 Avenue of the Americas. That is a legacy building, an old 6th Avenue tower that's been around, 60 or 70 years. Fox has renewed for another 20 years. The lease is for 1.2 million square feet in a 2 million square foot tower. So about 60% of the square footage. The building is owned by Ivanhoe Cambridge, and the property backs a $1 billion 2015 CMBS loan. So, why was this the mother of all, New York office green shoots for us? Well, number one, that part of Manhattan has been losing people consistently to Hudson Yards for a long time. And the fact that Fox is staying where they are and not moving to a Vanderbilt Tower or Hudson Yards or something like that, Manhattan West, is a big vote of confidence for the 6th Avenue corridor. The 6th Avenue corridor is a lot of older buildings, so it's another positive for that part of the market. And the fact that Fox is not downsizing at all, that they're keeping all 1.2 million square feet in that office, is just another great part of the story for the New York office market. And beyond that, I will say for the Midtown retail market, and by retail, I mean the bars, the delis, the casual dining restaurants, anybody in that area should be just really happy by this news. I think it's terrific.
Yeah, 20-year lease term in today's environment, really solid. And those downstream impacts that you just mentioned, man, this is a positive for the city. So great news all around.
A couple more green shoots before we get to a few crabs. This comes from Gail Kalinowski of Commercial Property Executive. Sovereign Partners sold an office building in Parsippany, New Jersey for $88 million. This is a 400,000 square foot office that was sold for $88 million to Signature Acquisitions. So a good sign there. The property last sold for $66 million 4 years ago. So about a 33% appreciation over the last 4 years. A great story there. And elsewhere, we saw that Workspace Property Trust has added another 1 million square feet across 6 suburban offices. They purchased the portfolio from Griffin Realty Trust for a price of $170 million. The narrative out there is that the office is dead. Nobody wants offices. Values are plummeting. And yet here we are this week with a 33% improvement in price in Parsippany, New Jersey, a huge portfolio by a REIT of over 1 million square feet, and that Fox News story of a 1.2 million square foot lease. So some green shoots to be sure.
I think the two most recent stories you covered there, the one thing in common was that these were for Class A spaces. So again, I think it kind of cements the narrative of, flight to quality, and Class A is a different animal in today's market than the other. So I think, this probably reaffirms a little bit what we have been talking about, but even if that's the case, it's good to see these stories come out. It's good to see these transactions happen. And hopefully, we'll continue to see, at least for the Class A properties, continued renewals, continued transactions, and interest in that, property sector.
One thing I didn't write down, but I just saw it this morning that I did see one more positive story in your neck of the woods, Lonnie, was Goldman signing on at 717 Harwood for, I think it was either 130,000 square feet or 170,000 square feet. I think Goldman is building their own facility down there. So this is kind of a way station before that other facility gets completed. But it is another vote of confidence for people coming back to the office that they're taking the space now. They're not waiting for their building to be done, and they're putting people back in their chairs at 717 Harwood right now.
Yeah, and that's been a market on Harwood specifically where there's been a couple of office buildings really struggling. In fact, I think there's one or two that are going through office to resi conversions right now. So it's good to see that lease, even if it's not long term, but at least until they get their building built, having some utility for that building is good to see.
So on the Crabgrass side, two things quickly. The first one from Kelly Boucher of the Minneapolis-St. Paul Business Journal, the Colonnade, which is a 16-story office at 5500 Wayzata Boulevard in Golden Valley. That sold for $79 million. The buyer was Eagle Ridge Partners and BLG Capital Advisors. Why is this a Crabgrass story? Well, the $79 million price was down from $100 million when it last sold in 2017. We have pointed out in the past that Minneapolis and Minneapolis suburb area has been hard hit with subleasing availability, especially among healthcare firms. So that may have something to do with why that property sold at such a big discount. Also, back in September, we noted that Vornado was looking to sell 40 Fulton Street in Lower Manhattan. Last week, that price was posted. The property sold for $101 million. The buyer was David Werner. Asking price for that building in early 2022 was 130 to 140 million, in that range, as reported by The Real Deal. And they get, basically a 30% lower total than what they were hoping for. So a couple of stories there, which underscore that the market is resetting in some parts.
The silver lining there is just that we're getting some clarity around, maybe what the haircut's going to have to be on some of these assets to get them to move. So instead of having a lack of transactions, we're starting to see some of these play out. I don't know if 20% delta in Minneapolis is enough of a discount, though, for me, based on the headlines we've seen over the last couple of months.
Yeah, so maybe it's a green shoot, right? The fact that somebody is still paying almost $80 million in a market that has seen several parcels being put out there of 400,000 square feet or bigger, maybe that's a green shoot, right? That we're still seeing somebody that's interested in that market willing to pay, a high 8-figure number for that type of thing. So I guess it depends on where you sit from these things, but it just goes back, we were talking about Twitter before, how the winds of fortune change. One day Twitter is everybody's darling in terms of, if we can only get Twitter to be our tenant and take 300,000 square feet, and now they become an anchor, and that can happen anywhere. For people that are new to this podcast or new to this market, I was talking with students at Clemson recently, and I ran off a list of retailers that at one time or another you would thought were the gold standard of who you'd want to be at your mall, right? Bon-Ton or Lord & Taylor or Sears or Macy's or JCPenney, Sports Authority, Toys R Us, right? All of these firms, if you go back to 2013 or 2014, you would have done, backflips to get these firms to sign on for space at your mall. And now half of them are gone, and the other half have been, gradually getting squeezed into smaller and smaller store counts. So it's just a reminder that a lot can change in a very, very short time period.
That is a perfect segue into retail. And one of the stories we were going to talk about was Bed Bath & Beyond that issued a warning that it's running out of cash.
Yeah, this has been out there as an area of concern for a while. Barron's, sometime in the last 3 or 4 months, we referred to it. BB&B was one of the firms that they said could run out of cash in the next 12 months. Stock was down 30% today. It's now trading for under $2. The firm gave, as you said, Martha, a going concern. They've been closing stores for a while. And, it's probably, there's a good chance that goes the way of Borders Books or Toys R Us or Babies R Us, that, there is no BB&B at some point, right? They've certainly lost market share to some of the big guys like Target's out there over time. They've lost the tailwind that was COVID. And probably one of the big tailwinds that nobody really ever thought about was how much their revenue was driven by home turnover, right? Every time you buy a new home or you get a new apartment, you go out and buy new bedding, buy new sheets and towels and everything else. You get rid of the old stuff. But if homes aren't selling, people don't go out and buy sheets every 5 years like they buy a car, right? You buy your sheets and you're done. And that contraction of the residential market in the last 2 years has to have some impact as well.
Yeah, the figures on Bed Bath & Beyond are not good. Quarterly losses of about 400 million, which is about a 40% increase year over year. Then unlike the other retailers that we've talked about for the last couple of months having excess inventory, part of their challenges is just getting enough merchandise to actually fill the shelves. So, they're not getting the inventory they need, which is obviously leading to fewer customers and just not looking good for Bed Bath & Beyond. I know we've talked about this, as you mentioned, man, it's the last couple of years, but it feels like this time there's probably nobody coming in to bail them out. Like, I feel like this is the time where we're going to see a bankruptcy, or we're going to see some sort of full restructuring or something based on what we're seeing here from the financials.
So a couple of reminders there, they've already been closing stores. They've been letting leases expire without renewal. We've reported on those in TreppWire periodically. We think more store closings will come. If they do go down the bankruptcy route, it will give them the ability to reject leases. So even if their lease goes out to 2028, a bankruptcy judge will allow them to accelerate that, right, to give back their leases. And then lastly, our own Stephen Bushbaum, who we've had on the podcast several times, he's putting together a list for our clients, which shows where Bed Bath & Beyond is a tenant. So our clients can get a sense of where they are tenant behind CMBS loans. It's not a small number. They have a lot of stores and they're out there. When we're on the bankruptcy topic, I will pivot very quickly to one other bankruptcy story. In the case of Regal Cinema, the bankruptcy judge came out in the last couple of days and said it was time for them to stop dragging their feet, that they have to start closing movie theaters and rejecting leases, that they were taking too long. And they came out with several new announcements of, it's not a ton yet, but they've announced more theater closings. And we think that will be another drag on shopping centers over the next couple of months. So another thing to keep our eye on.
And then two more stories of either layoffs or closures.
Yeah, so Stitch Fix, if you remember them, kind of an apparel box retailer, kind of mail order, see what you get in the box, keep what you like, send back what you don't. Said they're going to lay off about 20% of their salaried workforce and close the Salt Lake City distribution center that they have. So interesting to see. I think that concept was hot for a little while, but it's definitely faced some headwinds lately. Nordstrom closed their version and a few others closed their version. And then we talked about this, I think a little while ago, maybe a couple months ago, but 115 Sears hometown stores. These are the ones that are run by the independent dealers spread out across 36 states and Puerto Rico. They're going to, close the doors. Final liquidation sales, $40 million in inventory and discounts of up to 40%. So if you're looking for that, 1980s refrigerator or stovetop or that really hard to find widget that only comes in a plastic bag hanging on a rack somewhere in the back, now's your chance to go get it for 60 cents on the dollar.
I don't like to kick a company when it's down. Sears is about as down as you could be. I think they have 3 stores left in the US, but it does remind me, I guess their demise, we had some foreshadowing of this in my family about 10 years ago. I took one of my kids to a Sears. We were looking for like a blazer for some kind of school event or something like that. And Sears had already kind of thrown in the towel on new inventory and keeping their stores shiny and new. And the clothes were just kind of everywhere, right? They weren't hung up. There was piles of things and it was just kind of everywhere. It was just like, it was almost like a laundry bin. And then I took my son instead because we couldn't find what we wanted. We went into Lord & Taylor, which is, was nicely set up. Everything was on a hanger, and he turned to me and he said, "We are never going to Sears again." So for my 11-year-old,
a harbinger,
to have that awareness at the time was really, I wish I had taken that as an indication to short the stock at the time. I should have known better.
No, you should have taken them there for a socket wrench. That's the problem.
Well, I think it begs the question. You mentioned it earlier, man. It's like when you're talking to students at Clemson about, tenants that you would have, clamored over and now maybe not so much. I mean, Sears, Montgomery Ward, et cetera, those were the retail tenants that kind of were leading the way. And you wonder if maybe Amazon and some of these others that have really kind of taken charge for this generation, if in 15 or 20 years, we're looking at them in the same light that we are some of these other companies of the past. I mean, in terms of percentage of people they employ, there's a lot of similarities between some of these really large retailers and what Amazon does now for the market. So it'll be interesting just to keep our eye on that as we move forward.
There were a couple of other stories. Some of them were actually green.
Yeah, a lot going on in the retail segment. One of the real positives this week, I guess it's a positive. Westfield, as everybody knows, that's been listening to the podcast or is in the markets, they've been trying to get out of the mall space in the US for a year or 18 months. They've been talking about selling their assets. This week, they sold 2 properties. One was the Westfield Trumbull in Trumbull, Connecticut. The other is Westfield Shoppingtown South Shore in Bay Shore, New York. That's on Long Island for a combined $196 million. The green shoot part of that is, for one thing, the price. $200 million is nothing to sneeze at. And it does remove some uncertainty behind a $150 million CMBS loan that backs a 2015 deal. So there is a market and a market of size for shopping malls, to be sure. The buyer in that case was Namdar, who's made a industry or a career or a business out of buying malls around the US at reasonable or discounted prices and running them. And they were the buyer in this particular case. Other stories we saw this week: the Avenue Forsyth loan. This is a property in Cumming, Georgia. It backed a $75 million CMBS loan that missed its balloon date. That property has now sold. That's good news. The loan should now be paid off. CTO Realty Growth acquired the asset for $96 million. The loan made up almost 12% of a 2013 deal. So a positive story for that. Elsewhere, the shops at Waldorf Center. This is a $75 million CMBS loan that backs a 2015 deal. That loan was modified and has returned to the master servicer from the special servicer. The borrower in that case has negotiated a 2-year maturity extension these are of a piece. And these three things that malls continue to muddle through. Values may have fallen, but there's still a market in many areas for malls. And, in the case of this last one, the mall owner fought for the property and has negotiated an extension and is willing to put more money into the property.
Definitely a green shoot in the market. This comes from Commercial Property Executive. Realty Income Corp agreed to purchase about a 4.6 million square foot portfolio of net lease properties. There was about 185 retail and what they were calling non-core industrial assets as part of the portfolio. Total price of about $894 million. This was a cash acquisition. A couple of interesting takeaways on this was that the expected cap rate at closing on the portfolio was around 7.1%. And the weighted average lease term was about almost 10 years on the portfolio. And then about 50% of the annualized rent, comes from investment grade clients. So, I think this gives us some feel for these net lease properties of where the market perceives that cap rate and credit to be priced at. And so it'll be interesting to see what happens to this post-acquisition, but pretty strong deal, long weighted average lease term. At least we have some clarity around cap rate, and $900 million is a pretty big ticket, even if it's going to get 185 properties for that price.
So Lonnie, let's scratch beneath the surface on this one a little bit. I want to get your opinion on this particular deal. By way of background for our listeners, the kind of properties we're talking about here, when you're talking about a net lease to a credit tenant, think like a Walgreens or a CVS, where even if they close the Walgreens and the store is vacant, Walgreens is going to pay that lease to 2031, whether that store is open or not, right? You're not relying on the customer being there. You're relying on the strength of the Walgreens behind it to buy this. So that's the background. And with that, I'll get to the question, which is 10-year treasury today, let's say 375, something like that. So they were getting 330 basis points above the 10-year treasury for this. Does that sound a lot or a little? Like when you see a 7.1% cap rate, how do you feel about that? Does that feel like the buyer got a big discount? Do you think it's a fair price, or do you think otherwise?
Yeah, I think this is indicative of just where we're at in the market cycle. I think if this deal had come online a couple of years ago, you might have seen a couple hundred basis points less on the cap rate. What's interesting here is a lot of these properties have built-in step-ups on the rent. And so those step-ups may only be 3% or 3.5% or 4%. So, when you're seeing the inflationary period that we're in now, and the property owner not having the ability to actually raise rates to market, these assets can sometimes become less desirable. So I think 7.1 gives us a pretty good feel for what the market feels like this type of asset at this size goes for. Now, it's always hard to look at portfolios and we've talked about some of the nuances with cap rates generally. When you look at portfolio transactions, obviously, you're getting a much broader subset of properties and submarkets where you have really high demand and you maybe have, shorter duration leases or longer duration leases. It might be slightly different than what the average cap rate is across the entire portfolio. So I think the one takeaway here is that we've seen a transaction now. We have some market derived data to say this is what investors were willing to agree to. And it gives us some insight into that. It'll be interesting to see how this plays out more broadly, if this impacts some of these other, net lease type of properties, which there's an entire subset of brokers and buyers for these types of assets for the reasons you mentioned. A lot of them actually don't even view this as a real estate trade in some instances. It's really just an annuity, and they park their capital there and collect the rent. So it'll be interesting to see if this kind of kicks off some additional like type sales, or if this is kind of a one-off for terms that weren't disclosed here. Maybe there was a need to place capital or a need to exit. We'll see how this plays out over the next couple of months.
Two more stories that I'll touch upon very quickly. One green, one crab. Going back to Westfield, this goes back about a week, but we didn't cover it last week. This was, another big number. The owner of the Rams, Stan Kroenke, if I'm pronouncing that correctly, paid $325 million to Westfield for the Village, which is an outdoor lifestyle destination / retail property in the San Fernando Valley. That was said to be done at a cap rate of 5.6% on in-place NOI and a 10.6% discount to the last unaffected appraisal that came from a press release that we saw last week. If you didn't see it, reach out to us. We're happy to share it with you. But big number. Kroenke has not been shy about parting with draft picks to get top quality NFL players, and he won a Super Bowl because of it. And he's certainly not against paying top dollar for properties around that Rams stadium and training facility and so forth, because all of that stuff he's been buying lately has been in that same area. Crabgrass, lastly, sadly, it's again in Minneapolis, comes from Brianna Kelly of the Minneapolis St. Paul Business Journal. The St. Louis Parks Shops at West End, that's a retail center. It's sold for $65 million. The acquirer was Hempel Real Estate. The size, 380,000 square feet. Why did this catch my attention? Well, the property last sold for $117 million in late 2014. So 45% discount to that 2014 value. So overall, Lonnie and Martha, more green than crab this week. Not a bad way to start the year.
Yeah, good week. Good start to 2023.
Not too shabby. And a reminder, our team, the pod team, Haley, Manis, Lonnie, and myself will be at Crepsy, Miami, January 8th through the 11th, Sunday through Wednesday. Stop by our hospitality parlor on the 4th floor, suite 412. We'd be happy to talk to you about commercial real estate or other topics. And, love to hear what your perspective of how business is going from your point of view. So look us up.
Ask Haley to buy you a beer. She'll be carrying the corporate credit card and has a real thick expense account that she's coming with her down to South Florida. So, don't settle for the Coors Light either. You just go for that, St. Pauli girl or, one of those really expensive mixed drinks.
Yeah, Lonnie's going to have a drink with an umbrella and no doubt. And a number of shout outs. We had a lot of requests for some of our research that we've put out in the last couple of weeks. Brad M, Corey M, Hussein W, Matthew E, Michael P, Ben I, Andy B, and other shout outs. Amy F was introduced to the podcast recently and thinks it's great. Very excited to listen to our back catalog. So have fun with that, Amy. There's plenty to choose from. Mark S, as always, thank you for sharing wealth of knowledge, experience, and statistics. Keep it up. CLE Barton gave us a tweet, said he had gotten a sad giggle catching up on our podcast series where I was talking about Southwest Airlines reporting travels back with a fury. And then, of course, we had thousands and thousands of flights that were canceled. So on the nose, we weren't wrong. So that's good news, not good news, really. Solomon W, TreppWire's great podcast every Thursday with figures for all asset classes. Our own John D, Jonathan, probably, because I've truncated his name unnecessarily. If you aren't listening, you got to listen on Spotify. Siri Analyst on LinkedIn. If you find yourself with some downtime, check out the teaching team's favorite podcast. So they tagged us. Mark T loved our reporting in 2022, had some of his own predictions that included delinquency rate above 6%, war in Ukraine continuing, Fed pivoting too late, and the longer CMBS and CLO markets remain offline. Obviously not good for properties cash flow valuations.
We might have to nickname him, just like we had Steel City Dave. We might have to have Crabman for that gentleman. There was a lot of dark skies with those 2023 predictions. So, those we'll have to revisit those in a year. But we say that in, a completely mirthful way, calling you Crabman, just because we always have crabgrass and green shoots here on the pod.
And I don't know if you guys have seen, in the spirit of New Year's resolutions, Shopify is conducting a calendar purge, removing all recurring events with more than 2 people and having a meeting-free Wednesday. So getting rid of unnecessary meetings, I guess, is part of their list of resolutions. Don't know what's on your list.
Well, I would say for Lonnie's list, he should go out and buy a whole new set of towels just to help the Bed Bath and Beyond cause. And I would say that should go for you, Martha, and you, Haley, too. Go out there and support the cause. But
maybe I'll buy a candle.
A candle? All right, there you go. I've resolved to stretch more in 2023. I've found myself barely being able to touch my shins lately. And COVID made me quite sedentary. So I decided 2023 will be the year I stretch.
You're going to touch your knee?
I'm going to get to my shins before the end of the year.
Excellent.
I don't even want to know how bad. I think I can touch my knees, but I'm not sure. And I'm not going to try. But it's funny. My oldest son this weekend, he's 13. He was talking a little trash that he can beat me in a foot race. So we're going to have to line it up this upcoming weekend. And I have a sneaking suspicion that he's right. And if that's the case, I'm going to have to deal with that. So my resolution will be if I lose the race to my 13-year-old son, I'm going to have to get myself in shape so I can at least be competitive with him before the end of the year.
We'll see if that works. And we'll just have to see what Haley's is when we go to CREFC, find out her resolution. With that, we'll close. Thanks to our producer, Haley Keene. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or comment, send it to podcast@trepp.com and subscribe with your favorite provider. Thank you for listening and stay well.
All right.